behavioral finance is something that's always fascinated me, particularly as it relates to human nature and the biases that we tend to exhibit. As an investor myself, I'm always fighting to keep some of these behavioral finance concepts top of mind. With the longest bull market in U.S. history, I think it's a good time to talk about home bias and recency bias. Home bias is what it sounds like. It's the tendency for an investor to invest in their country of domicile more heavily than potentially international markets or markets abroad. While this familiarity can maybe appear to be, that you have extra knowledge or maybe an extra comfort level, sometimes this is really a false sense of security. And sometimes in really volatile times, you can confuse your familiarity for safety. Also, on the recency bias side, it is exactly what it sounds like as well. It's an investor will tend to invest in what has done best recently, right? We review a lot of allocations. We see a lot of folks come in and we ask them, why did you choose what you chose, whether it's ETFs, mutual funds, stocks, etc. And oftentimes the answer is as simple as, well, it's performed the best. And that's great, but I think you need to zoom out, okay, and take a step back and look at what are the underlying factors that have driven performance. I think this recent bull market and this recent run-up has really exacerbated both home and recency bias. Like I said, this bull market's been dominated by U.S. equities, particularly large cap growth stocks, mid cap, small cap companies as well. And it's led for a lot of investors to really focus on, okay, U.S. tech, large growth, here we go, pedal to the metal. I think it's good to have perspective that from 2000 to 2009, the S&P 500 was actually down 9.1%. I'll say that again. From 2000 to 2009, the S&P was down 9.1%. In contrast, the MSCI, an international index, excluding the U.S., the MSCI large cap index was up 7.4% during that period. So the point is that you need to be disciplined as an investor. 10 years might seem like a long time, but really oftentimes it's only covering one market cycle, maybe not even a full cycle. So we're obviously in an expansionary period now. We need to make sure that we stay disciplined. We don't just look to the past for performance, but we also look toward the future.
The Cautious Investor with Ryan Glinn is sponsored by W3 Wealth Management.